The escrow statement arrived in late August, folded into the rest of the mail like it had every year since the house was purchased. It listed the updated property tax assessment, the revised homeowner's insurance premium, and the recalculated monthly payment that would begin in October. Nothing dramatic had changed. The mortgage rate was the same. The loan term had not been modified. The house still stood in the same quiet subdivision 25 minutes outside the city. But the number at the bottom of the page had moved again. It was the seventh year in the home. The purchase had felt measured and responsible at the time. A fixed rate 30-year mortgage, 20% down, accumulated through steady dual incomes and years of disciplined saving. The neighborhood had good public schools, sidewalks wide enough for strollers, property values stable, according to every comparable sale reviewed during underwriting. The closing day had been orderly, wire transfer confirmed, keys handed over. The first evening in the house had been quiet, almost anticlimactic. Two working professionals in their mid 30s, both with employer sponsored retirement plans, both with health insurance, both carrying manageable student loan balances. Homeownership had been presented as the next rational step. The first year, the monthly payment felt large, but contained. Principal and interest were predictable. Property taxes were estimated conservatively. Insurance premiums were aligned with market averages. The escrow account held a modest cushion. By the third year, the tax assessment rose. The county cited infrastructure improvements and increased market valuations across the district. The monthly mortgage payment adjusted upward to account for escrow shortfall. It was an incremental increase, noticeable but not destabilizing. In the fifth year, homeowners' insurance premiums shifted more sharply. Regional storm patterns had changed underwriting models. Replacement cost calculations were updated. The insurer sent a letter explaining the broader risk environment. The premium rose again, and the escrow recalculated again. Each increase was justified in isolation. The household income had grown during that same period. Annual raises of 3 to 4%. One promotion. A modest bonus structure introduced in one role. Gross income looked stronger on paper than it had at closing. Retirement contributions were still occurring through payroll deductions. The 401k balances had benefited from market appreciation. On the surface, the trajectory appeared steady. The house, however, had begun to develop its own financial rhythm. The HVAC system required replacement in year 6. It failed in late June during a sustained heat wave. The repair technician confirmed the unit had reached end of life for its model year. A full replacement was recommended. The cost exceeded the emergency fund allocation designated for home repairs, so part of it was paid from savings that had been earmarked for a future vehicle purchase. That summer, the Homeowners Association dues increased. Landscaping contracts had been renegotiated. Insurance for the shared common areas had risen. The board circulated a detailed explanation. The quarterly assessment moved up by another $60. The house itself did not appear different from the outside. The lawn remained trimmed, the exterior siding intact, the driveway uncracked. Neighbors continued to mow on Saturday mornings. School buses still stopped at the same corner. Inside, the ledger was shifting. Property taxes rose again in year 7. Not dramatically, just enough to create another escrow shortage. The monthly payment increased for the third time since purchase. The principal portion of the payment had grown slightly as amortization progressed, but it was offset by higher escrow requirements. The total outflow each month was now several $100s higher than the original underwriting estimate. The mortgage balance had declined. Equity existed. The home's estimated market value had appreciated according to online valuation models. On paper, net worth had increased. Cash flow told a quieter story. Two car payments overlapped for 18 months when one vehicle reached high mileage earlier than expected. Auto insurance premiums followed national trends and edged upward. Health insurance payroll deductions increased during annual open enrollment due to employer cost sharing adjustments. Utility bills climbed gradually, reflecting broader energy pricing changes and seasonal variability. None of these developments were reckless. There had been no speculative investments, no second property, no luxury renovations. The kitchen cabinets remained original, the bathrooms unchanged since move-in. The homeowners had not extracted equity through a line of credit. The mortgage remained untouched. Yet the fixed expenses attached to the home were no longer static. The realization did not arrive in a single moment. It accumulated in spreadsheets reviewed on Sunday evenings. In the steady comparison between gross income and monthly obligations. In the awareness that discretionary spending had narrowed without a conscious decision to reduce it. Weekend travel decreased. Dining out became less frequent. Contributions to a taxable brokerage account paused 1 year to rebuild cash reserves after the HVAC replacement. The retirement accounts continued, but the additional investing that once felt possible began to compress. The house absorbed financial bandwidth. Maintenance requests appeared unpredictably. A minor roof repair after a winter storm. Tree trimming to prevent damage to power lines. A plumbing issue traced to aging fixtures. Each invoice was manageable. Together, they formed a pattern. The mortgage amortization schedule projected payoff in 23 more years. The homeowners would be in their late 50s by then. Retirement planning models assumed continued employment, continued contributions, and moderate market returns. The house was listed as an asset in every projection. It was not liquid. It required ongoing funding to maintain. Suburban homeownership carried embedded costs beyond the monthly mortgage payment. Commuting expenses were higher than when renting closer to the city center. Gasoline, vehicle maintenance, tolls. The trade-off had been square footage and school district quality. The financial exchange was ongoing. At work, both careers progressed in incremental steps. One role stabilized with predictable annual increases. The other experienced restructuring during a corporate merger, resulting in a lateral move without salary reduction but without growth acceleration. The dual income structure remained intact, but neither income experienced dramatic expansion. The house payment, meanwhile, did not recede. By the 8th year, homeowners insurance was requoted with a different carrier to mitigate premium growth. The new policy was slightly less expensive, but coverage deductibles were adjusted. The savings were marginal compared to the cumulative increases over time. Property tax assessments continued to reflect rising neighborhood valuations. Comparable sales supported the county's position. Appeals were considered but not pursued after reviewing data. The assessed value was aligned with market conditions. The Homeowners Association initiated a special assessment to repair shared fencing and resurface community walkways. The amount was divided over 12 months. It was not catastrophic. It was simply another line item. During tax season, mortgage interest deductions were lower than in earlier years due to principal paydown. The federal tax benefit associated with homeownership decreased gradually. The mortgage interest portion of each payment shrank as amortization progressed, which was financially sound but reduced itemized deductions. The house had once represented stability. It still did. There was no landlord, no lease renewal negotiation, no sudden rent increase tied to market demand. The walls could be painted without permission. The backyard belonged to them. But stability required continuous capital. Friends who had continued renting in urban apartments experienced annual rent increases, sometimes sharply. They also avoided roof replacements, foundation repairs, and property tax reassessments. Their housing costs were visible and renegotiated annually. The homeowners' costs were layered and compounding. Equity statements from the mortgage servicer arrived quarterly, showing declining principal. The numbers were mathematically reassuring. Loan to value ratios improved. Credit profiles strengthened. Liquidity narrowed. Emergency savings targets were recalculated several times to account for the true cost of maintaining the property. 6 months of expenses meant a larger absolute dollar figure than it had at purchase. The safety buffer required to feel financially stable grew with the house's obligations. In year 10, the exterior required repainting. The prior owner's paint had reached the end of its life cycle. Contractors provided estimates. The lowest bid was still substantial. Delaying the work risked deterioration of siding. The project proceeded. That same year, one income plateaued. A performance review acknowledged strong contribution but cited budget constraints on salary growth. Inflation in consumer goods and services continued at a moderate pace. The nominal income increase did not materially change take-home pay after healthcare deductions and retirement contributions. The mortgage payment, including escrow, was now nearly 25% higher than the original monthly figure at closing. The house itself had not expanded. It had not become more luxurious. It required ongoing input to preserve its condition and its market value. At neighborhood gatherings, conversations often centered on interest rates and resale values. Several neighbors refinanced when rates dipped in earlier years, lowering their payments temporarily. Others who purchased later entered at higher price points. The homeowners in this house did not refinance. Their original rate had been competitive, and closing costs would have offset marginal savings. The financial profile of the subdivision evolved. Some households carried higher debt loads. Others paid cash for renovations. Some moved out as job relocations occurred, replaced by new buyers at elevated prices. The cost basis of living in the neighborhood rose collectively. Inside the house, retirement projections were adjusted annually. The home was included as part of total net worth. It was not included as part of income generation. Selling in retirement was an abstract possibility, but not an immediate plan. The children had settled into local schools. Social networks formed. The commute, though long, was routine. The house anchored daily life. It also dictated a minimum income threshold required to sustain it. A period of temporary job uncertainty in year 11 revealed that threshold clearly. Corporate restructuring resulted in a 3-month gap between roles for one income. Severance covered part of the shortfall. Savings covered the rest. The mortgage payment continued uninterrupted. Property taxes did not pause. Insurance premiums remained due. The house did not adjust to employment volatility. After re-employment, contributions to retirement accounts were restored to prior levels, but taxable investing did not resume. The financial recovery focused on rebuilding the emergency fund depleted during the transition. The house remained the largest single monthly expense. Online valuation tools now estimated the home's worth at significantly more than the purchase price. Paper equity had expanded. Market appreciation had been steady across the metropolitan area. Real estate agents periodically mailed comparative market analysis suggesting favorable selling conditions. The homeowners did not list the property. The cost of purchasing a comparable home in the same district had also risen. Transaction costs, moving expenses, and higher interest rates made relocation financially neutral at best. The house became less a stepping stone and more a fixed point. As the 12th year approached, deferred maintenance items were reviewed. Aging windows, driveway resurfacing, appliance replacement schedules. None were urgent simultaneously, but each had a timeline. Budgeting for them required forward allocation of funds. The mortgage balance was lower. The required outflow to maintain the asset was not. Over time, the realization settled in without ceremony. The original purchase had been financially responsible by conventional standards. Fixed rate financing, substantial down payment, stable employment. The house had appreciated. Net worth had increased. Yet, the cumulative cost of ownership extended far beyond the principal and interest line on the initial loan estimate. Property taxes tracked market values upward. Insurance premiums responded to regional risk recalibrations. Maintenance followed the natural aging of materials. Association dues reflected shared infrastructure. Utilities fluctuated with energy markets. Commuting expenses persisted as long as employment remained city-centered. The house absorbed income growth incrementally, adjusting upward in parallel. The financial space that once existed between earnings and fixed obligations narrowed slowly, not through mismanagement, but through accumulation. Each adjustment was rational, each invoice legitimate, each increase modest when viewed independently. Together, they redefined the household budget. By the 13th year, conversations about early retirement no longer reference specific ages. They referenced feasibility. College savings contributions were weighed against maintenance reserves. Vacation plans were shaped by quarterly property tax disbursements from escrow accounts. The house remained well kept. The lawn still edged. The exterior freshly painted. Inside, furniture had been replaced gradually as needed. Nothing suggested strain from the outside. The escrow statement continued to arrive every August. It continued to list updated figures. The payment continued to adjust. The mortgage amortization schedule continued its steady progression toward a date 2 decades away. Equity accumulated quietly. So did obligations. The house stood unchanged at the end of the street, in a subdivision that still marketed itself as stable and desirable. Its financial footprint, however, had expanded each year without requiring any single dramatic event. The realization did not alter ownership. It did not trigger a sale. It did not produce a decisive shift. It simply remained present, folded into the monthly budget alongside the updated escrow amount.